In this question, a company is buying a piece of equipment for $1 million. It's paying for the equipment by using $700,000 of its own cash and financing the remaining $300,000 through an installment loan. It then asks how the transaction would impact the company's equity position. There are 2 nuggets of knowledge that will help you answer this question correctly. Nugget number 1. Students may be more familiar with the concept of net worth for an individual, so it may help to think of a company's equity the same way. For example, to calculate the net worth of an individual, we take the total value of her assets on a specific date and then deduct all of the money that she owes. To determine a company's equity position, we do the same thing. We determine the total value of its assets and then deduct all of its liabilities. See, the calculations are the same. Nugget number 2. If you are asked how a certain transaction may impact a company's equity position, determine its statement of financial position before the transaction and then again after the transaction. Let's do that now as it applies to this question. Let's assume that before the transaction, the company's only asset was $700,000 in cash, and it had no liabilities. If we take the $700,000 in total assets and deduct 0 liabilities, we determine that the equity figure is $700,000. That is our starting point. Next, let's think through how the transaction detailed in the question would impact its statement of financial position. Its cash figure would now be 0 because the $700,000 has been spent on the equipment. However, it would now have a piece of equipment worth $1 million. This means its total asset value is now $1 million. But what about the liability side? It now has a $300,000 installment loan outstanding. Notice that if we take $1 million in assets and deduct $300,000 in liabilities, its equity is still $700,000. Accordingly, we select the answer that says the transaction would have no impact on its equity. And we are correct! Growing up, if I said something like, I'm going to invest in a new pair of shoes or PlayStation or whatever, my dad would always reply with something like, don't call that investing. You can't improve your net worth by shopping. As much as I hate to admit it, he's right, and this works as a great memory aid for this concept. Whether a company buys a piece of equipment with cash, or with a loan, or a combination of both, it will have no impact on its equity position. Now, of course, if that piece of equipment helps it increase its future profits, and those profits are retained within the business as opposed to being paid out in dividends, it would lead to a future increase in equity, but that's a whole other video.